Hi, everybody. How are you? Hope you are well. So, today we're going to talk about the 5 assets to buy so that you'll never have to work again. So, wouldn't it be great if we had this information at the age of 20? So, if you know anyone in their 20s, tell them about this channel. All right. So, the first asset, number one, the one I talk about a lot, real estate. Real estate. So, real estate is important because when you buy real estate, the cash flow from the real estate is going to pay you for the rest of your life. So, can you imagine if you had started this at the age of 20? So, buying property, generally, you buy for cash flow. That is the reason. So, you have a physical place that is giving you money every month. And so, the cash flow. Also, the appreciation. The appreciation is the increase in value of the home. It increases in value depending on the area. If you bought in an appreciating area, it increases in value. And this appreciation is what is actually building your wealth. So you have the cash flow coming in, you have money coming in every month for the rest of your life. And you have this appreciation that is taking place if you bought in an appreciating area that is building your wealth. This is building your net worth and it's building your wealth. So, real estate, that is the first asset. This is allowing you to pay less in taxes legally because there are a lot of tax benefits associated with owning real estate. So, that is the first class. Of course, um, you have to study before you actually buy the real estate, like learn how to analyze a property, making sure that you're getting a good deal and not a bad deal. Um, so, real estate, that is the first asset. Very important asset to have. Now, everybody is not interested in real estate, and real estate is not even a part of the retirement plan for a vast majority of people. So, just by knowing that real estate is so important that it should be a part of your retirement plan, um, kind of makes you ahead of the game. Just knowing that piece, how important real estate is. So, number one, real estate. Second asset is stocks. So, there's different kinds of things that you can be investing in when it comes to stocks. There is the index funds, there are the mutual funds, there are ETFs, there are the individual stocks. And so the index funds, those are run automatically by a computer. The mutual funds would be managed by an actual money manager. And then the ETFs is kind of a hybrid where the ETF is going to make dividends off of your money. So, what a dividend is essentially just because you own the stock, you're making money because of the fact that you own a stock. So, ETFs create dividends for you. And then individual stocks, that's just like going and picking a stock. So, individual stocks is generally not recommended because if that one company were to go bankrupt, then you would lose all of your money. So it's more recommended to get into a whole basket of stocks, which would be your index funds, your ETFs, as opposed to individual stocks. Individual stocks can be considered riskier. Um, however, um, some people still have both. Individual stocks, just like a small percentage. There have been cases where, say, Amazon, for example, people have bought Amazon before it became a big business. And then After it became so successful, so it shot up from this point to this point, and the people that took a risk and bought that individual stock made a whole bunch of money off of Amazon. So even though individual stocks is riskier, some people still choose to buy individual stocks. Like nothing wrong with buying individual stocks as long as you know what the risk is. So keep in mind, I'm not a financial advisor. This is not financial advice, just for educational and informational purposes only. So, the big basket of stocks is safer, the index funds, the ETFs, and then the individual stocks is riskier. But I would not avoid individual stocks because, like I said before, sometimes people make a whole lot of money off of individual stocks. But just make sure that you know that you're taking a risk when you buy into individual stocks. So that could be a smaller portion into individual stocks as opposed to the portion that you put into the big basket of stocks. So again, you have the index funds, you have the mutual funds, you have the ETFs, and then you have the individual stocks. So that is a second class of assets, which is the stocks. So stocks are very important. You know that the stock market is kind of shaky. It has ebbs and flows. It goes up and down, up and down, up and down. But it always goes back up. But in 2008, it went down by 40%. So you had to have the wherewithal to stay in it and know that it's going to go back up. Only the people who bailed out and took their money out, those are the only people who lost money. But the people who stayed in it, knowing that it's going back up and it's going back up higher than it was before, those are the people who gained wealth. So the stock market has a little bit of trust factor, you know. Some people look at the stock market as they think it's a lottery. They think it's a game, and they say they're not playing with the stock market. Where the people who are wealthy, they're in the stock market, and they've been in the stock market for a long time. And I mean decades, not years. So that is the second asset class is stocks. Number three, business. So creating a business is important. So you could either have your own business that you create, or you could invest in someone else's business. Like you see on Shark Tank, they are investing in other people's businesses. Startups generally. Um, when it comes to startups are risky because you don't know if the business is going to be successful or if it fails. So if it fails, then that means that you're going to lose all of your money, right? So there is no guarantee when it comes to investing in startups. And actually, you're more likely to lose your money investing in startups. So you could lose your money, or the business could take off and be super successful and you gain money. But you should know that it could go either way investing in startups. There's no guarantee when it comes to investing in startups. And so the laws have recently been changed as far as investing in startups go. That used to be only for a certain sector of the population because they wanted to keep the vast majority of people out. And so the laws have been changed on that where more people can start investing in startups. So if you're interested in investing in startups, there are actual platforms out here where you can invest in startups. Some of those are Republic, Start Engine, and WeFunder. Those are some platforms where you can invest in startups. Keep in mind, this is only if you have money to play with. This is not money to build. So you should know the risk when it comes to investing in startups. So if you're looking for security, something that's going to be safe and something that's going to build your wealth without a shadow of a doubt, that's real estate. So if you're looking for peace, that's real estate. So I mentioned the three assets so far. Mentioned real estate, mentioned stocks, uh, mentioned business, creating your own business or investing in startups. Creating your own business is very important because, as you've seen with the pandemic, it's important to have multiple sources of income, not just one. So, not just depending on a job that they can take away from you whenever they get ready. So, you can have your job and you can also have your business, right? So, creating a safety net for yourself by creating your own business. Number four, cryptocurrency. So, cryptocurrency has been in the news lately a lot, right? So, cryptocurrency is very speculative. And so you know that the headers in cryptocurrency as the Bitcoin and the Ethereum, as far as cryptocurrency goes, cryptocurrency is very speculative. It could go to zero. On the other hand, Bitcoin is still up. I mean, of course, it dropped, and that's why people lost money. But what if you got in when it was at $1 and now it's like 27,000? So it's still up compared to where it was. At one point, it had went up to 60,000. So the people who got in when it was 60,000 and then it dropped down to 27,000, that's where you see the loss. But what if you got in at this point where it was $1? Now it's at 27,000. Okay, this is how it actually looked. $1, 27,000, 60,000, back to 27,000. See where I'm going? See what I'm saying? So it's still up compared to where the start is, but it's very speculative. No one knows what is going to happen. No one knows um, what regulations are going to take place, right? People are trying to take control and trying to regulate it, trying to do everything else with it. So, as far as cryptocurrency goes, just keeping it should be a very small amount of your portfolio because it still is speculative. Um, but again, um, it has great potential. So it's better to be in it in a small portion than not to be in it at all. So only putting in what you are willing to lose when it comes to Bitcoin, knowing that it could go to zero, but it also could create wealth. It started here, it went all the way up here, and then it went down. Crypto, speculative asset, very small amount um, of your portfolio. It's a good idea. So, this is not advice. So, I'm just talking about the asset classes here. So, number five, the fifth asset class, gold. Gold. So, physical gold is a good idea. Do you have gold? The reason why physical gold is a good idea, in a small portion again, right? Reason why gold is a good idea. This is to hedge against worst case scenarios. Worst case scenarios. What are worst case scenarios? Where, well, um, they decide we're not going to use the US dollar anymore. um, whatever other worst case scenarios you could think of. So this is to hedge against worst case scenarios, um, and then just a tiny amount of your portfolio. Physical gold, the actual physical gold, not gold through an ETF, not paper assets, but the actual physical gold that you can actually go to and pick it up in your hands and have it in your hands. Physical gold to hedge against worst case scenarios. So those are the 5 asset classes. Investing in these 5 different areas, making sure that you are diversified and not just depending on one thing, not putting all your eggs in one basket. Could you imagine if we had had this information at the age of 20? So again, if you know anyone in their 20s, send them over to this channel. There is no reason for the next generation to be starting over from square one when you already have the information. So send them over to this channel. Also, if you are interested in learning how to invest, I have a course. You can check out the course. It is below. So I talk about things like how compound interest works, what is the actual stock market, some good things to invest in. It's not financial advice, remember. I talk about retirement. How much money are you going to need for retirement? And how much money are you going to put away to actually get there? What is the plan? Do you have a plan? So, a lot of people are not aware that we should have a money plan. So, I talk about that. What is your plan and the actual steps to get there? So, if you are interested in investing, you can check out the link below. All right. So, those are the 5 asset classes to put you in a very, very good position um, to even retire early if that is what you desire. There is a woman who retired in 2 years using real estate. Now, she is not on my show, but I saw her on other shows. So, real estate is very, very powerful, more powerful than you can even imagine. All right. So, if you like the channel, do me a favor and hit the like button. Hit the subscribe button if you're not a subscriber and notification bell next to it so that you won't miss the episode. Also, leave a comment. Let me know your thoughts. And before you leave, if you got any value out of this, please hit the like button. Thank you for watching. Have a good rest of your day.